Welcome to the debate. Today, we're diving into something pretty significant, shaping the 2025 AI ecosystem. It's this paradox everyone's calling the Great Disconnect. So on one hand, you've got this incredible, almost unbelievable supercycle of investment. Big tech CapEx is, well, accelerating to something like $320 billion, just pure financial power. But set against that massive spending, you see this catastrophic failure in enterprise ROI. Studies are suggesting, up to 95% of generative AI projects, they're just not delivering measurable P&L impact. And that lack of return, it creates a really fundamental instability. So the central question for us today is this. What's the core threat here? What really jeopardizes the long-term sustainability of this whole AI ecosystem? Is it the structural, the macro financial risk, all this questionable capital flowing around? Or is it more micro? Is it organizational failure rooted in just flawed enterprise strategy and, well, execution? Now, I'll be arguing that the primary risk, the really existential one, is structural and financial. The foundation just feels too shaky for these valuations.
And I'll be taking the position that, while those financial flows are certainly dizzying, they really represent the necessary cost of building this new economic engine. I think the true core risk lies squarely in the massive organizational and, frankly, implementation failures we're seeing everywhere. That 95% failure rate you mentioned, that isn't really a symptom of impending financial collapse. It's a systemic crisis of adoption. The problem is internal execution, internal maturity, not a lack of external capital or infrastructure supply.
Okay, so my position is essentially that this ecosystem, right now, it's a structural paradox. It's built on a financial foundation that just isn't sustainable. The sheer scale of the infrastructure investment is, well, it seems completely divorced from any real end-user value pull-through. Let's look closely at what some analysts are calling the $1 trillion paradox. Big tech CapEx is fueling this literal infrastructure arms race. For example, estimates put spending on just specialized NVIDIA training chips in 2023 at around $50 billion.
$50 billion, yeah.
Right. Yet that huge investment apparently yielded only about $3 billion in new application layer revenue. Now, that's a 6% return on arguably the most critical foundational piece of the entire AI stack. A utilization rate like that, well, it fundamentally backs up the macro financial risk argument, I think. And there's more. Analysts have calculated this potential $500 billion hole. What that means is, even if every optimistic AI sales projection actually happens, we'd still have $500 billion of infrastructure investment that just can't be justified by real-world revenue flowing back into the system. See, this market isn't self-sustaining through, proven application monetization. It seems to be sustained by this kind of unique mechanism, circular financing. Basically, big tech funnels VC money into startups, and then those startups, either contractually or just practically, have to turn around and spend that VC money buying more big tech cloud services and specialized hardware like those NVIDIA chips.
So big tech is effectively paying for its own chip demand using external venture funding. It's the self-reinforcing loop, and it artificially props up valuations across the whole ecosystem, really independent of whether end-user enterprises ever get concrete, measurable financial value out of it. The system relies on these capital flows, not actual application revenue.
Okay, that's a compelling data set on the infrastructure layer, I grant you. But we really have to focus on where the failure is empirically manifesting, where it's accelerating. And that's clearly at the enterprise level. The alarm bells are ringing because the acceleration of project abandonment is just staggering. The share of companies abandoning most of their AI projects, it's jumped from, 17% in 2024 to 42% in 2025.
42%, wow.
Exactly. This massive surge in failure, exceeding 90% by some metrics, it's universally categorized by, the consulting consensus as a business transformation challenge. It's not seen as a technology problem per se. The root causes are overwhelmingly micro-organizational and operational. you've got a huge number, 57% of companies, admitting their foundational data just isn't AI ready. Then there's pervasive cultural resistance, significant talent skill gaps, and this crushing weight of pilot paralysis, where, get this, 88% of AI pilots never manage to actually transition out of testing and into production. 88%. So yes, we're definitely in Gartner's Trough of Disillusionment. But look, this is probably a necessary maturation process. It's like a rolling correction, moving from that initial, frankly, overheated hype cycle towards a sustainable adoption cycle, where ROI finally becomes paramount. Success, everyone agrees, is determined by having a strategy-first mindset, really focusing on people and process. The bottleneck is execution and organizational maturity, not a lack of infrastructure or capital floating around at the top.
That's a powerful argument about those internal barriers, certainly. But let's really interrogate the foundation that's supporting all those failures. If execution were the only bottleneck, how do you reconcile that organizational difficulty with that, frankly, startling gap between the infrastructure spend and the application layer revenue? The financial success of the entire infrastructure layer, NVIDIA, the specialized hardware makers, the cloud providers, it's fundamentally predicated on big tech's internal commitment to just keep pumping hundreds of billions into this arms race. The revenue we're seeing is mostly infrastructure layer revenue, right? It's not application layer pull-through from enterprises actually paying for valuable AI services. So, what happens if big tech leaders look at their own P&Ls and they determine that the ROI on their massive, say, $320 billion CapEx just isn't materializing? If they decide it doesn't justify the spending and they consequently cut back their commitments, well, then the entire financial structure of the AI market is fundamentally jeopardized. That's a systemic macro-financial risk, and it exists regardless of whether, a few organizations finally manage to fix their data governance or their talent pipeline. Enterprise failure then becomes almost an inevitable consequence of an unsustainable financing model.
I understand the skepticism towards that level of CapEx. I really do. But I would frame it differently. That high infrastructure spending is arguably the necessary, unavoidable cost of building the foundational technology that's going to fuel potentially decades of productivity growth. And we're already seeing some early results, right? The economic impact is estimated to be contributing about 1 full percentage point to U.S. GDP growth already. So the investment might be justified by the sheer magnitude of the long-term transformation, not necessarily by the immediate monetization of this first wave of enterprise apps. Now, what's truly driving the enterprise disappointment, I believe, is the accumulated implementation debt. That's the technical and process deficit that enterprises built up by rushing all those proofs of concept, those POCs, without doing the really hard work, the required process reengineering, the data restructuring, the culture change in parallel. You can see the market signals clearly bifurcating now. The froth, the overhyped, low-value applications, that's being corrected. It's being filtered out. But the foundational infrastructure layer remains strong, precisely because the long-term market growth outlook is still exceptionally robust. We're talking projections of over 30% CAGR. So this cooling off, it's actually a healthy filtering process. The high investment is justified by that strong long-term outlook, provided enterprises can learn how to adopt the technology correctly. And this execution failure, it's really being severely exacerbated by specific external factors that are exploiting this organizational vulnerability. I'm talking specifically about agent washing.
Yes.
Right? This deceptive rebranding of, simple workflow automation or basic rules-based chatbots or even existing RPA, pretending it's genuinely autonomous agentic AI capable of complex decision-making. Gartner actually found that less than 5% of vendors claiming they have agentic AI capabilities possess genuine autonomy. This widespread deception, it creates massive amounts of wasted investment inside companies, and it practically guarantees project cancellations. They're projecting something like a 40% failure rate by 2027, specifically because of this. It directly fuels those high enterprise disappointment numbers we discussed. So the fault here lies significantly with vendors making false promises and the lack of rigorous internal organizational vetting frameworks needed to tell real innovation apart from just, clever rebranding.
I'm not entirely convinced that this deception is just an isolated vendor issue, though. I think instead it speaks directly to the structural imbalance that we've identified. See, agent washing thrives because the market structurally rewards these visible, easily packaged technological promises much more than the, frankly, unglamorous, difficult, multi-year work that's required for deep organizational transformation. And this dynamic is structurally reinforced by that severe reality gap often found within the C-suite. Senior leaders, they frequently have this much rosier view of AI investment. They grossly underestimate how difficult it is to address the real adoption barriers, things like data quality and process integration. Because they're insulated from the messy, on-the-ground reality of legacy systems and poor data, these C-level executives become easy prey for vendors who are peddling these washed products, promising simple, plug-and-play, almost magical solutions. So that high-level disconnect, combined with the structural market bias towards hype, that's what enables the deception to spread systemically. It makes it a critical vulnerability of the whole ecosystem, and it's fueled from the top down. Let's maybe pivot back for a second to how the capital flows seem to confirm this idea of structural failure. If, as you claim, organizational strategy is the ultimate solution, then why are the big five consulting firms emerging as the primary financial beneficiaries? They're generating massive, almost disproportionate revenue from AI services. BCG, for instance, is apparently deriving a full 20% of its entire revenue from AI work. Accenture just logged $4.1 billion in Gen AI revenue in 2024 alone.
Right. Those are big numbers.
They are. And this consulting gold rush, doesn't it suggest that enterprises are essentially paying enormous sums of capital just to manage and navigate systemic implementation failure rather than achieving lasting, measurable transformation? It looks like the flow of capital is benefiting the navigators of complexity, the consultants, not the deployers of actual sustained enterprise value. That structural dynamic, well, it implies a fundamentally questionable market mechanism, doesn't it? Money is flowing to those who help clients cope with failure, not necessarily those who successfully achieve ROI.
Okay, that's a compelling point about the revenue streams of the Big Five, definitely. But let's look deeper at the strategic advice they are unanimously offering. I mean, if they were simply profiting off chaos, you wouldn't expect them to universally preach the same difficult, mostly non-technical path to success, would you? The consensus from McKinsey, BCG, PwC, it's crystal clear. Success hinges almost entirely on people and process, not just spending more on technology. BCG, for instance, specifically advocates for their 10-20-70 rule. They advise that successful transformations allocate only about 10% of resources to the algorithms and the tech itself, 20% to data infrastructure, and a full 70%, the vast majority, to people and process change, the organizational rewiring, as they call it.
70% to people and process.
70%. So the very fact that consulting firms are making billions selling this strategy, well, it confirms the problem isn't the availability of capital or infrastructure at the top. The problem is that most enterprises simply haven't made that necessary strategic pivot yet. They're still focusing their investment disproportionately on the algorithms, the shiny 10%, instead of on the foundational organizational change, that crucial 70%. And look, the fact that a small cohort of AI leaders is successfully navigating this terrain precisely by rigorously adopting this kind of strategy proves that the solution does lie in execution, in organizational maturity, and really in internal strategic will. The structure, I'd argue, is fundamentally sound. It's the adoption that's lagging behind.
I appreciate the focus on organizational maturity, I really do, but the fact remains the AI ecosystem, as it stands currently, relies on what looks like an unsustainable financial loop. The data is just stark. Infrastructure investment is outpacing application revenue generation by, well, an alarming margin. That $50 billion chip spend yielding only $3 billion in revenue, it perfectly illustrates this profound gap. This structural volatility, it creates systemic risk. It means that enterprise implementation failure at that 95% rate isn't just poor execution. It might be a predictable consequence of a market that structurally rewards capital expenditure and tech hype over demonstratable, hard-won application layer ROI. If that funding structure collapses, well, the best organizational strategy in the world isn't going to save the market.
And yet the evidence, I believe, overwhelmingly points to a crisis of adoption and organizational maturity, a systemic failure to execute properly. Those high failure rates accelerating to 42% project abandonment, they seem clearly rooted in internal barriers. Poor data, massive talent gaps, that pilot paralysis phenomenon, and just a deep cultural reluctance to fundamentally rewire core workflows to actually accommodate this new technology. So the current turbulence, including that consultant gold rush you mentioned, is probably best understood as a necessary, though definitely painful market correction. And it will likely stabilize once enterprises truly commit to the strategic, largely non-technical transformation work that the industry consensus keeps outlining. The tools, arguably, are ready. It's the users who are not quite there yet.
It seems the source material really requires us to differentiate carefully between this financial risk and the execution risk. It suggests the path to a truly sustainable AI future needs a much clearer understanding of both the structural pressures driving those huge capital decisions.
And absolutely, the foundational requirements for successful long-term enterprise execution. We really have to look closely at both the macro-financial structure and the micro-organizational reality to fully appreciate the dangerous complexity of this great disconnect.